Hello, Accounting Superstars. This is Professor Don Bush from the Accounting Superstar channel. I've been a professor for about 30 years and a CPA for about that long, and I've got great ways to explain accounting. You've come to the right place if you want to learn accounting. One thing I can do is explain things in very simple, easy terms that people will understand. Well, today's lesson is about absorption costing. It's a rather advanced topic, and it's something that most students don't understand. Most students never understand it. And it took me a while to understand it too, to be completely honest. It's a rather advanced topic here. It's hard to imagine or picture. So, but if you want to read about it in your textbook, it'd be in the section of called Absorption Costing versus Variable Costing. That's usually how it's titled. And I'll make more videos on this too, because this is just an introduction to this weird problem. And what it is if we follow our accounting rules, if we do our accounting according to GAAP, some weird stuff happens. Stuff that where it makes the company look like it's doing better than it really is, or doing worse than it is. And that's not good. We want to know how the company is doing, but there are some real imperfections in accounting, and this is one of them. And sadly, it's the way we're required to do accounting. We really have no choice when it comes to presenting financial statements. Now, there is a solution to this, and it's called variable costing. And but right now we'll focus on absorption costing, because that's the way financial statements need to be done. All right, we can't use variable costing for financial statements. I wish we could. It would probably make things a little better. So here is what's happening, folks. So here's the information for 2001 and 2002. So this is the Sunset Sailboat Company. They make beautiful sailboats, beautiful custom sailboats. And in 2001, I've got an income statement right over here. In 2001, 20 boats were sold. And in 2002, 20 boats were sold. Now, the two years are identical, totally identical. Same sales, same revenue, same expenses, same everything. Okay, and I know that's not possible in real life, but just imagine it to be so for this example. Well, the next thing here is that 20 sailboats were produced in 2001 and 25 sailboats were produced in 2002. So the production side of things, 20 sailboats produced in 2001, 25 sailboats produced in 2002. So that's the only difference. So what happened is that in 2001, they made 20 boats, they sold 20 boats, okay? In 2002, they made 25 boats, but sold 20 boats. All right, so now the income statement is based on sales, so you'd think that the income statement would be the same. So coming down to the income statement, here it is. And so I've got cost of goods sold here where you can't see it right now because I want to make a big point here. So look at this. Sales for 2001 was $2 million. They sold 20 boats, $100,000 per boat. And in 2002, they sold 20 boats at $100,000 each, and that's $2 million bucks. Now, in a moment here, I'll uncover cost of goods sold, but look at this. Gross profit is better in 2002, and selling and administrative expenses are identical either year, and net income is better in 2002. So why is it better? Because they sold 20 boats in both years. So why would the income statement would be better in 2002? And especially if all the costs are the same, all right? All the costs were the same. In the office, in the factory, they were all the same. So let's check out cost of goods sold here. So in 2001, cost of goods sold, and let me change the color of the print here just a little bit. Let me undo that. Here we go. Let me do this differently. There we are. Was 1.5 million. And in 2002, 1,460,000. So it may not sound like a lot, but what happened was the management got really excited. They go, wow, hey, we're doing better. We're doing great. Look at this. In 2002, our profit is 240,000. And in 2001, it was only 200,000. And they'd have a hard time explaining it. Well, why? Why did they do better? Because sales were identical and selling and administrative expenses were identical. It's just cost of goods sold was different. So did they operate their factory more efficiently? The answer is no, they did not. They operated the factory the same as last year. But so why are the numbers different? And that's where the problem is that 2002 looks better when in fact it isn't better. It's not better. And you might say, well, what's the big deal? Who cares? Well, first of all, in 2002, we're telling the managers that the company's doing better when in fact the company's not doing better. We're also telling the investors in the company that the company's doing better when in fact the company's not doing better. We're telling the bank that the company's doing better when in fact we're not. I mean, everybody thinks that the company's doing better, but they're not. And so if you're an investor, and I hope, if you're not already, I hope someday that you'll become an investor, invest in the stock market. These are things you got to look out for, because you might think that the company you're investing in is doing better when in fact they're not doing better. So let's see why. Let's see what's going on here. So coming on down here. So coming on down, here we go. I'm going to split the screen here so we can see two things at once. So let's do this. It looks like cost of goods sold is the culprit here, or at least that's the source of the problem. It's the only reason why we're different by $40,000. So let's look into cost of goods sold more deeply. Well, cost of goods sold is made up of three costs, and you should know these costs. They're manufacturing costs: direct labor, direct materials, and manufacturing overhead. So let's look at this. Direct labor, same for both years. Direct materials, same for both years. So where's the problem? Well, the problem's with this manufacturing overhead. In the first year, manufacturing overhead was $250,000. In the second year, it's $210,000. Now, why is it less? Why is manufacturing overhead less? I thought these 2 years were supposed to be the same, no difference. And manufacturing overhead's different. Well, let's look into that more deeply. So let's look a little bit further. So here's that cost of goods sold. So I just have the same chart up in the upper half of the screen. So let's scroll down the bottom chart. So looking into manufacturing overhead, why is manufacturing overhead different? Well, if we break manufacturing overhead up into variable and fixed components, variable manufacturing overhead is identical. And it's because the 2 years were identical. But it's the fixed overhead that was included in cost of goods sold. That's the problem. So in the first year, the fixed overhead included in cost of goods sold was $200,000. In the second year, $160,000. Now, I thought fixed costs were fixed, and these 2 years are supposed to be identical. There's supposed to not be a difference. Why is it that the first year is $200,000 and the second year is $160,000? It's like, this makes no sense. And why do I have it written included in cost of goods sold? What is it included someplace else or something? What's up with this? But that is the reason why we're $40,000 off, but we still don't know why. So let me scroll down a little bit more. Maybe we can figure this out. So in the upper part of the screen, I've got the same chart as the one below. So I'm going to scroll down below here. I'm going to scroll upwards. So let's look at this fixed overhead included in cost of goods sold. What's up with this? Let's see if we can figure this out. Total fixed manufacturing overhead for the year is $200,000, and that's the same for each year. And you think about it, well, both years are identical, and fixed overhead is fixed, and they ought to be identical, and they are. All right, but here's the problem. The number of sailboats produced. 20 were produced in the first year, and 25 were produced in the second year. And so you might say, well, so they were more productive. Isn't that a good thing? And I suppose it's a good thing, but it's distorting the income statement here. So what's happening here is the fixed overhead per boat is, for the first year, $10,000. So how do we get that? Well, 200,000 divided by 20 is 10,000. Second year, 200,000 divided by 25 boats produced is 8,000. So if we put this on a per boat basis, the fixed overhead per boat is different. In the first year, it's 10,000 per boat. In the second year, 8,000 per boat. And you might think, well, that to me sounds pretty good. They operated their factory more efficiently, and they got more out of their fixed manufacturing overhead costs. You know, instead of making 20 boats, they made 25 boats. What's bad about this? Well, that's a good thing. They were more productive. We're getting down to the answer here. We're getting down to the reason why. Here's what's going on, folks. Is that the title of this chart right down here, fixed overhead included in cost of goods sold and ending inventory. So we're going to find out that in the second year, fixed cost, some of it went to cost of goods sold, some of it went to ending inventory. So that's going to be the key here. So number of boats sold, okay, 20 boats were sold in both years. So fixed overhead per boat produced, well, 10,000 in the first year and 8,000 in the second year. And if you can't remember why that is so, rewind this video a little bit and rewatch a little bit of it. So the fixed overhead included in cost of goods sold. So what we're going to do is we're going to just do a little multiplication. 20 boats times 10,000 per boat is $200,000. And 20 boats sold times 8,000 is 160,000. Okay, let's stop here just for a second. Just for a second, let's go back up to the income statement. Going back up to the income statement. Here it is. Look at this. The cost of goods sold is off by $40,000. Off by 40. They're different. Where the 2 years ought to be identical. And check this out. The fixed overhead included in cost of goods sold, it's off by 40,000. And you would think they'd be the same because both years are identical, but we're learning that no, they're not, just because of the way we do our accounting. It's not that the company's doing better. So coming back down to this bottom chart, let's figure out the rest of it here. So number of boats in ending inventory. Well, during the first year, there was no ending inventory. They produced 20 boats and they sold 20 boats. There was no ending inventory. But in the second year, they produced 25 boats but sold 20 boats. So they had 5 boats in ending inventory. 5 boats in ending inventory. So the fixed overhead per boat produced is 8,000. And where'd that number come from again? Let's go back and check. Here it is. Here's where that number came from. Total fixed manufacturing overhead for the year, 20,000, and they built 25 boats. And if you go 200,000 divided by 25, you get 8,000. So that's where that 8,000 comes from. So 5 times 8,000 is our missing 40,000. So what happened is some of the fixed manufacturing overhead went to cost of goods sold, and some of it went to ending inventory. So some of the fixed manufacturing costs never got expensed. And the amount was $40,000 that went to ending inventory. There's our difference. So total fixed manufacturing overhead, just to reconcile it, well, 200,000 plus nothing here is 200,000. And 160 plus 40,000 is 200,000, which is the amount of fixed overhead. So here is the moral to the story, okay? And I'm going to end it with a question here. So the moral of the story is this: when production is greater than sales, when you produce more than you sell, a portion of fixed overhead costs go into ending inventory rather than being expensed in cost of goods sold. In other words, or that is, net income will be greater. But here's my question to you guys, and I hope you know the answer. However, is the company really doing better? Net income's better, but is the company really doing better? Or do we have an accounting distortion to where we're not being told the truth? All right. Could it be just that our accounting system is just not perfect, you know. Imagine that, not perfect. So anyways, I hope this video helped you out. And if it did, hit the like and subscribe button. And check out accountingsuperstars.com. I've got all these videos listed by topic, so that way you can find them easier. So check it out, folks. Until next time, over and out.